Financial joins me. Welcome, Luke. It's good to have you back on the show. We were talking about some of the stories that are on the minds of investors and traders this morning. I'm curious, in terms of U.S.-China relations, how closely have you been watching that, and how big of a deal should that be as some of the, again, focus on the pandemic maybe eases a little bit and we get back to some of these geopolitical concerns?
Yeah, thanks for having me on, Ben. We have been watching it fairly closely, and I think that if we do get some focus off of the pandemic, it will return to the forefront. And one of the things we've been watching very closely over the last month or two, there was a document put out by the U.S. White House on May 20th, and it is a strategic document, 15 or 20 pages long, lays out what one of our best relationships on Wall Street, when we forwarded it to them, they said, wow, this reads like a war scroll. It says, that the United States is returning to great power competition with China, and lays out all the ways that's going to happen. And so it was, I think, a really important document in terms of defining the relationship in a very overt way, how it is going to go going forward. And the way it sounds is basically laying out another Cold War like George Kennan did back in the late 40s, early 50s with the Soviet Union.
Well, it'll be interesting to see if that ratchets up to that level, considering how recently what we've been seeing. It seems like tensions kind of flare up a bit, and then they both sort of, whether it's the U.S. or China, sort of take a step back and kind of ease those tensions a little bit. Let's talk some about, speaking of ratcheting up, let's talk about those mortgage numbers that are increasing. Should this be a concern, or is it just a reflection of some of the stimulus measures that were available, some of the efforts that the Fed made available for banks and ultimately lenders to kind of have a bit of a cushion during these difficult times?
The mortgage numbers have been, last week we saw them, I'm assuming he's talking about the ones that are good numbers. And it was interesting here in Cleveland. I was talking to a real estate agent recently, and they said that they're seeing bidding wars break out for houses in suburban Cleveland, which is, I've been in this area for most of my life. I've never heard that it's Cleveland, right? So I put a tweet out about it, and I've got 65, 70,000 followers. And it was fascinating. It's happening all over the country. Suburbs are there's bidding wars breaking out in suburbs all over the country. And there's a lot of different speculation for why that's happening. Some of it, people moving back from the coasts. There was a lot of hypotheses that people, after what they've seen in the last month, have decided that the whole moving into the city thing does have its drawbacks, and that the suburbs might be a better place, a safer place. Some of it could be millennials, family, but it's this really big non sequitur relative to what we've seen from the economic data in terms of 50% GDP declines and massive amounts of job losses over the last 3 months. And so I'm kind of scratching my head a little bit, but it was really interesting to see, to hear this here. And then when you put it out on sort of a primary basis, to hear that it's happening across the country in a lot of different cities.
Yeah, we've been talking a lot about, it's just mind-boggling for me that people are buying homes sight unseen. Some of the trends we've been seeing. Today we'll get some information in terms of housing data. This week, actually, there's some pretty good housing numbers, so we'll get some more information as far as that, and if those trends are continuing or what's playing out there. Let's talk a little bit about financials, because this ties directly into the housing and some of the discussion we were just having there as far as people, their ability to borrow, and if they have jobs or don't have jobs ultimately, and the rate at which they're able to borrow money to buy homes. Let's talk about the fact that rates, Luke, for the most part have been very much range bound. We're going to be taking a look at Treasury, the charts later on in the show, but whether you're looking at the futures or interest rates, you can see the March highs and lows remain. What do you think could be the next catalyst to get us above or below those really well-defined upper and lower extremes that we established earlier this spring?
I think we may be range bound for some time, and we're starting to hear, of course, the talk about yield curve control. Yeah. That's something we've been talking about that we thought was an inevitable outcome whenever we had the next downturn, given sovereign debt levels, given Treasury debt levels, that the Fed would be forced to do that. They're overtly talking about it now. I think that's very likely to happen in the back half of the year if it's not de facto being done already, per your point in terms of the range bound. And so to me, as I think about the financials, as I think about rates, I think rates will probably be range bound for some time, either, and then it gets to this binary scenario as it relates back to the financials, which is we're coming up on periods of time where stimulus is rolling off. In theory, fiscal actions are being pulled back a bit in theory. And is the economy ready for that? And so if we get a softer economy, of course, if the government does not step in with more stimulus or the Fed doesn't do more on the balance sheet side, then we could get into moving back towards the lower end of that range on rates. And if they do more, my guess is you'll see rates move higher on expectation of better growth. Only to be either jawboned or outright capped by yield curve control. And so I think that we're probably most likely to remain range bound in treasuries. And I think that's just a matter of necessity. Once you get our debt levels to where they are at the federal government level, which is 120, 130% of GDP, it becomes a matter of national security to control your interest costs. And so they're going to do that. Over time, I think that does drive inflation, and I think it starts off in asset price inflation. And so that's how I'm thinking about the Treasury curve at this point.
Well, I wanted to get your thoughts, Luke, on we're looking at the Treasury curve here right now. I've actually been keeping an eye on that shorter end as well, how it has been holding lower levels relative to the longer, and especially a nice discrepancy between the 30-year recent activity and the shorter end of the yield curve. Let's talk about the U.S. dollar, because there's been a bit of a very well-defined inverse correlation recently in terms of some of the recent price activity, at least throughout the month of June. It seemed like end of May as far as dollar and the indices. I wanted to get your thoughts in terms of what that range-bound activity that you were just talking about in terms of rates and some of the potential catalysts there could mean for the U.S. dollar right now, and what you're seeing, because it's sold off quite a bit. Is there more to come here, or is this just sort of some of the volatility that's going to play out as we inch forward and as some of the dust settles related to the pandemic?
I think as it relates to the dollar, it's going to depend very heavily on what the U.S. government does on the fiscal side and what the Fed does on the balance sheet side. And last week, we saw the Fed's balance sheet shrink for the first time since February. I thought that is a potential big signpost. We'll see if that continues in coming months. But that's in theory a withdrawal of liquidity at a time where you're going to continue to have these very big Treasury auctions. All else equal, those two factors, withdrawal of Fed liquidity and big Treasury auctions, should be supportive of the dollar. The wild card in that, or one of the wild cards in that, I should say, is what's going on with the Treasury General Account, or TGA, which is historically been very well correlated with the dollar over the last 5 to 10 years. And so when the Treasury builds up its balances at the Treasury General Account, they're withdrawing liquidity from the system, and the dollar tends to be fairly well bid, and vice versa. Well, we've had sort of this curious inverse relationship, or the relationship not holding in the last month, where the TGA has risen to its highest level ever, as far as I know. It's over $1.4 trillion, and the dollar has not responded. It's been flat to down, as you noted. And so historically, when that Treasury General Account begins being spent into the economy, then they're injecting liquidity into the economy. It's been negative for the dollar. Will that hold again? I would think it would, but then again, I think it depends what's happening on the other side with what the Fed's doing with its balance sheet, what the government's doing on the fiscal side as well. So for me, I think the weak dollar and the positive risk assets, I don't think was an accident. I think that going forward from here, given where we are on the fiscal side, the debt side, still weak economic growth, how far below the productivity, how big of a productivity gap we have or output gap we have, I think the way that authorities are going to need to keep asset prices up, to keep stimulating the economy, I think the way they're going to have to do that is by keeping the dollar weak.